How's it going, everyone? Today's video is going to be about how I size my trades. I got a few questions on this, and I recorded a video previously, but I had some audio corruption thanks to our good friend OBS. So I'm re-recording this and also redoing my thinking. I was writing out a lot more of my ideas on this point, trying to get something more helpful and more thought out. So this is my attempt to do so. So when talking about sizing, let's start a little bit high level and then we'll get into what I do. I think sizing ultimately comes down to two things: your confidence as a trader and your confidence in the trade. So the first part as a trader, if you're in that one share, one contract journey, you're doing one share, one contract for a reason, because you shouldn't have a lot of confidence as a trader. You're still learning. You want to save yourself a lot of money because you know you're going to make mistakes. Now, if you're someone like Pete, who has been consistently trading for many, many years, over a decade, he's taken 1,000 shares of a trade, right? He is very confident in his ability to trade. The second part is confidence in the trade. One share, you obviously can't do a half size, but let's say you're doing something like 100 shares, but maybe your market conditions are not a very trending day. Maybe the stock setup is okay, but not the best. So perhaps you do 50 shares. That's a half size. Or maybe it's the perfect setup you like, the perfect market conditions. You double up, you do 2x size. So that's the second part of that equation. Now, my sizing method has nothing to do with these two parts, but I think those are the most two important parts. So I wanted to go over that first. The second part that I'm focusing on here is dependent upon the following observation. Some stocks are just more volatile than others. We have to take this into account when making our game plan. So what does that mean? Let's take two examples here. So the first one is Tesla. Tesla's price is $251. It has an ATR of about 10. Second stock here is MCD. The stock is also at 251, has an ATR of 4. So you know that Tesla is going to be more volatile. And what that really means is that there's a much higher chance of Tesla getting a $2, $3, or $4 move than MCD is going to get a $2, $3, or $4 move. The ATR is one of our biggest clues in determining how much a stock can move on a certain day. There are certain days where we exceed our ATR. Let's look at this. We had a high of 276, a low of 269, about 270. So that's a $6 move where we expanded our ATR. So $6 is a pretty big move for a stock like MCD, especially at the time where the ATR was lower. It was 3.89. But what about a stock like Tesla? So we have an ATR rising, and it's pretty low over here as it's in compression. So it's rising to 9. And let's look at this move over here. We have a low of 218 and a high of 231. So this stock moved $13. You know that this stock is going to be more volatile, more likely to move dollar for dollar because you have the higher ATR. Now, as part of your game plan, you want to take this into account, and that's where this video sizing comes into play. There's not a right answer to this. The answer is, do you want to ignore the volatility of the stock, or do you want to embrace the volatility of the stock? And I think that's where the different sizing methods come into play. This graph is my attempt to lay out how these two areas, or how these three different strategies orient themselves across different trade-offs. So the two factors here is volatility and also buying power. If you're trading a smaller size, buying power may not be a huge concern. For example, if you're trading 100 shares and you have 4x margin on day trading, you're probably not going to hit your buying power constraints. But if you're trading like 1,000 shares, even 500 shares, depending on the stock, you may hit some buying power constraints. So that's kind of another factor to keep in mind. So X-axis here, we ignore volatility or we embrace it. Y-axis is we account for buying power or we kind of ignore buying power on the trade. So let's say you have the same number of shares. So let's say on McDonald, you take 100 shares. On Tesla, you take 100 shares. The question you may ask is, let's say you want to get $1 on the move. Which stock is more likely to get $1, Tesla or MCD? Now, $1 is pretty doable for both of those, but I think your answer would have to be that it's way easier to get a buck on Tesla versus a buck on MCD because that average true range is so much higher. Tesla may move $1 in a single candle. Let's zoom in on this a little bit here. I mean, let's even look at this yesterday, right? Low, 241, high, 243. So this moved about $2.20 on a single bar. It's a pretty big move. Let's compare that to something like MCD over here, where it is making moves, but let's look at a bar like this. We have a low of 250.32, a high of 250.86. So this moved 50 cents. This is a pretty big bar. Now, granted, the volume isn't as low, but you can see that McDonald's isn't as much of a mover relative to Tesla. So it's much easier to get $1 on Tesla than $1 on McDonald's. So if you had 100 shares, and let's say you got a nice win on Tesla, let's say you got $2-3 on Tesla, that's a nice $300, right? So it makes more sense for you to get in those high ATR tickers if you can win on them. Now, the flip side of that is when you embrace volatility, you also have to embrace the downside risks that come into that. So if you are wrong on Tesla, you will get penalized much more than if you're wrong on MCD. Because maybe if you're wrong on MCD on a day trade, maybe you lose $1, right, out of a $4 ATR move. If you're wrong on Tesla, you could lose something like $2.50, $3, even $4 on that trade. So you get more money on your winners, but you lose more money on your losers. How about a fixed dollar amount? So this is pretty interesting. Let's say you do, $10,000 for every trade, regardless of the trade. Now, the interesting part about this is that you are fixing your buying power for each trade. So if a stock that's more expensive, you're going to buy less shares. A stock that's less expensive, you're going to buy more shares. And this does naturally account for some differences in volatility, which is why I put it in the middle. So what's a good example of that? Well, as price goes up, volatility tends to correlate with that. Obviously, it's not one for one, as you just see with Tesla and McDonald, but something like McDonald's, which has an ATR of 4, is going to move more than a stock like CLSK, for example, which is it's a very volatile stock relative to its price, but has an ATR of 1.4. So cheaper stocks tend to make smaller dollar for dollar moves. And more expensive stocks, maybe something like ASML, right, is a very expensive stock. It's going to make a higher ATR move generally. And this is on the low end of the range, but on some of these, it's getting $20, $25. Even something like SMCI, right, $57 ATR move. This is a big mover. So it does tend to incorporate volatility in this, but not that much. And the issue personally for me that I ran with the fixed dollar amount is that since you are only accounting for price and not always ATR, you tend to get higher risk, higher reward on these cheaper stocks with very, very high ATR. So something like this would be an example of Carvana. So let's compare something like Carvana, which is at 128. This has an ATR of 7.26, which is very, very high. What about something like, MMM, for example? Right, this is about $100. You can see the ATR is way lower. But if I was doing a fixed dollar amount, I would pretty much buy the same exact amount of shares. They're very similar in price. So on a stock like Carvana, I'm embracing, again, more volatility in those kind of stocks. So as long as the stock price is the same compared to stocks of equal price, you're not accounting for ATR. But against stocks of different price, you are sort of incorporating for ATR. So this wasn't bad, but I kind of wanted to pretty much ignore the volatility. And my reason for doing this is that if I got a good setup on MCD, I wanted to make the same amount of money and have the same loss profile versus a stock like Tesla. I didn't want to be limited in that department. So what I decided to do is divide by the ATR. And I'll show a calculation of this as an example. But essentially, the higher the ATR of the stock, the less shares I buy. And that's what dividing is essentially doing. You have a bigger denominator, so the number of shares you're going to use is going to be much smaller. So how will that work in practice? So here's a good example here. Let's look at Tesla. And I know this is at 251, has an ATR of 10, right? And so I have this arbitrary number. I call it a scalar. And this is what I use to size up. So right now my scalar is 50. So I do 50 divided by the 20-day ATR right here. And that tells me the number of shares to buy. So I discount that as I get the number of shares. So higher ATR, less shares, lower ATR, more shares, even though the price is the same. And in this case, I don't really care about price. What price really does is it constrains me buying power wise. But if your shares are very low, I'm not really worried about the buying power, because to me, the price of the stock isn't exactly what I'm risking on the trade. The risk comes from the volatility of the stock and also the setup and the market conditions, right? So the volatility to me is a much more important part of the risk reward profile of any stock that I'm trading than necessarily the price. Like, I don't care about the price of the stock. The price is just part of the buying power constraint. So obviously less buying power involved, but I know that if I have, let's say, a 1/4 ATR target, right? So this is on a day trade. That's kind of a passive target I have. It just tends to work pretty well across the board. So if I want to get a 1/4 ATR of this 250, I know that's kind of my price target for the share. And I know for McDonald's, having a ATR of 250 doesn't make as much sense because it only moves $4. So the chance of me getting a $2.50 move on McDonald's is way lower than the chance of me getting it on a stock like Tesla, where that can happen on maybe one sort of move up. So because I have ATR as part of the game plan in terms of my passive profit targets, if I have a 1/4 ATR target, that's only $1 on MCD and $1 or $2.50 on Tesla. And so when I hit my profit target, they end up being roughly the same. And that's pretty much all it is. I'm just discounting the volatility that comes with each stock. Now, I'd like to end this by saying that this is a preference and it's not the only way to size up. There are some traders who take a fixed number of shares and they go for those higher ATR stocks and they incorporate that as part of their game plan. You can be consistently profitable with other methods. For me, I like the evenness of a risk-reward profile across my trades. I want to know that I can make the same amount of money on MCD versus the same amount of money as Tesla if I size them appropriately relative to their volatility. And it gives me more consistent profits day to day, where maybe Tesla's not setting up, but McDonald's is setting up. I don't want to be penalized for trading a lower ATR ticker versus a higher ATR ticker. So thanks for listening, everyone. I hope this was helpful. And if you have any more questions, let me know.